Welcome to the Gold Machine. We're going to dive straight into this explainer today to look at a massive, albeit quiet, anomaly that is literally reshaping global finance right under our noses. It's driven by some of the most powerful and, frankly, cautious institutions on Earth. This is a story of trust, uncertainty, and a whole lot of capital. And to really wrap our heads around the sheer scale of what's happening, we've got to start with the numbers. 5,000. In 2025, a record-breaking 5,000 tons of gold were purchased globally in a single year. That is a scale entirely unmatched in modern history. We're not just talking about a busy quarter or a little blip in demand here. Not during the major gold rushes, not during the world wars, not during any financial crisis in recent memory have we seen physical accumulation happening at this breathtaking pace. And when you translate all that raw tonnage into a fiat valuation, you get this absolutely staggering figure, roughly $555 billion. That's a 45% jump in overall value from the year before. It was a surge so powerful that it relentlessly pushed the metal to 53 new all-time highs over the course of the year. To put that into perspective, that equates to a brand new historic price record being set almost every single week. Section 1. The 5,000-ton anomaly. Who is buying and why? So, what makes this data so fascinating isn't just the sheer amount of gold changing hands, it's who is actually doing the buying. We're not talking about retail day traders or doomsday preppers. We're talking about sovereign governments and risk-averse central banks acting with incredible coordination. Now, historically, central banks are pretty cautious, right? They usually sell off assets when prices spike. But what we're seeing right now is a complete inversion of that logic. We're looking at a 15-year consecutive streak of net buying that kicked off back in 2010 and just kept plowing right through the 2025 price surge. The jump from the 2010 to 2021 average of 473 tons straight up to the towering figures in 2024 and 2025 is just wild. And you might actually be surprised by who is aggressively leading this charge. It wasn't the US, and it wasn't officially China. Poland led the pack in 2025, adding 102 tons in a single year. That massive purchase pushed gold to represent a staggering 28% of their entire foreign reserves. Think about that. A nation that spent decades under Soviet economic control is now one of the most aggressive accumulators of physical gold on the entire planet. Which, naturally forces us to ask a pretty uncomfortable question. What do central banks know that we don't? When the institutions with access to the absolute best economists and global data, the very organizations that manage the world's money, are stockpiling a physical asset at this pace, we really have to ask what exactly they're preparing for in the coming years. Section 2. 1971 and the Trust Standard. The day money broke. To truly understand the coordinated actions of these central banks today, we have to step back 54 years to a Sunday night television broadcast that fundamentally changed the concept of money forever. On August 15, 1971, President Richard Nixon officially severed the US dollar from gold convertibility. After an initial run in the 70s, the data shows 2 full decades from 1980 to 2000 of flatlining, where gold was largely forgotten, just written off as a relic of the past. But then, that 2010 central bank buying streak kicks in, leading directly to the explosive record of 5,000 tons bought in 2025. It all really comes down to fiat currency. That is, money backed not by physical commodities you can hold in your hand, but entirely by trust in the issuing government's promise. Since that single decision in 1971, the entire world has operated purely on a system of trust. And historically, whenever that trust wavers, whether it's from mounting national debt, sticky inflation, or sudden geopolitical shockwaves, the world retreats to the one asset that requires zero trust to retain its value. Section 3. The de-dollarization shift. Moving away from the dollar. For decades, the US dollar has functioned as the default language of global trade. If you settle debts or hold emergency reserves, you hold dollars. But relying so heavily on a single foreign currency comes with immense risk, especially if those reserves can be instantly frozen or devalued by decisions made entirely outside your own borders. And that specific risk has triggered a monumental, albeit quiet, shift. In late 2025, gold officially overtook U.S. Treasury bonds to become the single largest reserve asset on the planet by value. Really let that sink in for a second. The exact asset that was cut loose from the dollar in 1971 is now worth more in aggregate global reserves than the debt of the very country that cut it loose. And this shift is definitely no accident. The World Gold Council's survey data backs this up flawlessly. The numbers are overwhelming. 95% of central banks expect global gold reserves to keep rising. 43% actively plan to increase their own country's holdings this year. And a staggering 0%, literally not a single surveyed bank, plans to sell. This near-unanimous confidence proves that this move away from fiat reliance is a highly deliberate, ongoing strategy. Section 4. The Retail Investor Trap, where beginners lose everything. Now, we absolutely have to discuss this next part because the way institutions utilize gold is very, very different from how beginners often rush into it out of fear. First, we have to strip away the hype and just look objectively at the data. Over the last 5 decades, from 1971 to 2024, U.S. stocks have delivered an average annual return of 10.7%. Gold, over that exact same stretch, averaged about 7.9%. That's just the math. Stocks won, on average, over the long run. So if you're buying gold expecting it to universally outperform the stock market over decades, history shows you're kind of playing the wrong game. But those long-term averages hide the real story of why institutions buy it. Gold acts as a shock absorber. It's a modest portfolio allocation designed to move differently during market collapses, offering stability rather than high growth. Gold is not a get-rich-quick scheme. It is absolutely not a complete replacement for your stocks. It is simply a financial shock absorber. And treating it as a massive, high-stakes bet, well, that's a devastating yet common mistake. There is a stark contrast between investing and trading here. Investing is a deliberate, long-term decision, prioritizing modest, balanced allocations. Trading, on the other hand, is a high-risk skill, utilizing leverage, requiring you to react instantly to things like Federal Reserve announcements or CPI data drops. Trying to day trade gold with high leverage around news events without mastering the skill, that will quite literally wipe out a beginner's account in a matter of minutes. Section 5. 2 possible futures. What happens next? Without making any wild predictions, we need to impartially analyze the massive macroeconomic forces that are currently driving this market toward 2 very different potential outcomes. Both of these futures are genuinely possible. On one side, we have forces that historically create upward pressure on gold: sticky inflation, falling interest rates, a weakening dollar, and rising global geopolitical tension. On the flip side, forces for downward pressure: cooling inflation, higher rates held for longer, a strong dollar, and easing global tension. Which path we take depends entirely on how these incredibly complex factors resolve in real time over the coming months. Which brings us to our core takeaway for today. Uncertainty isn't the flaw in this story, it's the entire point. Anyone claiming they can guarantee which of those 2 economic paths we're going to take is not analyzing the market objectively. They are just selling you a story. Gold's entire 5,000-year history as money and a reserve asset is built entirely on acting as a mirror that measures human uncertainty. So rather than trying to predict the unpredictable, we're left to look inward. Ask yourself, is your portfolio prepared for either future? How would your own financial strategy handle the unexpected shocks of tomorrow, regardless of which path the economy takes? I'll leave you to chew on that provocative question. Thank you so much for diving into this with me, and I'll see you in our next explainer.